Jeff, great to catch up with you, sir, following the Fed decision on Wednesday. Let's do it again this morning, following the data this Friday morning. Your response to this one, Jeff, just a blowout jobs report.
It is at first blush, Jonathan. You often say the first reaction is not the last reaction. So just a couple of things to consider here in terms of this first reaction. You know, number one, and I think it's been mentioned already, in terms of headline payrolls, there's a lot of seasonality in this number. If you look at the spread of expectations, it's one of the widest expectations spread of any month. This is, I think it was mentioned before, you know, consecutive January upside surprises. You have a lot of seasonality effects that may be overstating the strength in that payroll number. Number two, in terms of AHE, I think you have to be a little bit careful about reading too much into the big upside surprise on AHE. A couple things going on there. Number one, you always have a mix shift. Mike McKee went through the mixture of the jobs. A lot of that, what you saw there was that the lower end paying jobs were actually not as large of a contributor as the higher end. And additionally, the reduction in the work week also flatters the AHE number. Much more important is what we got earlier this week in terms of ECI, kind of validating the disinflation in terms of wages. So not to take anything away from the initial reaction of this is a very strong report and a strong labor market. And what that does is it's less about kind of, Lisa, interesting question, agree, you know, should they be tightening? No, there is a pace here for normalization. It's just not as quick as what the bond market was expecting, and it's not as soon.
Jeff, the takeaway from Wednesday's news conference for many was this Fed would embrace stronger data, and if we weaken, they'd be able to step in and reduce interest rates perhaps sooner. That reaction functioned far more market friendly. Is there anything about this story that changes that in any way, shape or form?
I think it reinforces it, you know, in kind of thinking about what the market reaction would have been, upside miss, downside miss. I think we're right along those expectations. Stronger than economic data, that's good news. This economy is strong. But I think what it pivots is that the Fed doesn't have to normalize policy as quick. You know, you asked me a couple of meetings ago, my expectation, my answer was June. What's the rush? Similar to what Mohammed just said, there's not a rush if there's not an economic slowing. And I think as you see the strength in the economy, the pivot in the focus of the market and the conversation is going to move away from inflation. We've kind of won the battle on inflation. Still a debate as to where that settles in, but much more about how strong is this economy and what that tells us about what the Fed continues to believe and say. They think they're restrictive. But if the economy stays well above potential is what we've been at, then you got to question where that restrictiveness really is. And that really calls into question the longer-term path of expectations of Fed cuts this year.
Which is exactly why I'm wondering, and I'm interested in the sell-off in the 10-year yield, up almost 10 basis points. Does this make you, Jeff, not like longer-term bonds nearly as much?
Well, we've always had, not always, but in this cycle, more of a preference for the front end of the curve. A number of reasons for that. But to answer your question, yes, it just reinforces the skepticism we have in terms of long end duration in portfolios playing the role that it used to. You know, flight to quality used to mean you buy the front end. And now I think that's what it means again. So for investors looking for that ballast in their portfolios, it used to be you wanted to own the back end. Now you want to own the front end because that's where most of the interest rate declines are going to occur. And that back end is vulnerable to an increase in term premium, inflation premium. And I think that's what you're seeing here today as well.